With so much talk about a housing crash and this not recession, I decided I was going to bring back Dr. Joey von Nessen, University of South Carolina's research economist, to get to the bottom of this. What's up, everybody? Welcome back. As always, I'm Bill Olson, your favorite YouTubing Charleston realtor, and I would like to welcome back my friend and special guest, Dr. Joey von Nessen. Joey, how's it going today?
Great to see you, Bill. Doing well.
Yeah, well, thanks so much for coming back. I mean, we did a video at the beginning of the year talking about how hot the market was and where it was going to go. And I think just like in 2020, like no one expected what was going to happen over these past few months with, we kind of came to a screeching halt, it feels like, from where we were. So I kind of want to get your view on this as a research economist. Like, where is our economy going here in South Carolina? How is that affecting the market? And I really want to address that elephant in the room. The question that everyone has is, when is the market going to crash?
Well, it's a great question. And of course, there's a lot of uncertainty right now about where we are headed. But maybe we start by talking about that term, market crash. When is the market going to crash, and what does that look like? Because I think if we look back at the past two recessions, one of the challenges we have is to put where we are today in perspective. Because in 2020 and also in 2008, remember the Great Recession, both of those periods where we saw an economic contraction those were associated with a significant economic downturn where we saw very high levels of unemployment. We saw industries affected across the board, and in a real sense, an economic catastrophe during both of those recession periods. So that is what is anchored in many people's heads when they think about an economic recession or a downturn. But that's not normal. We can have economic recessions that are not nearly as severe as what we saw in 2020 and 2008. And so I think if we do see a recession later this year or even in 2023, that's what we're looking at, more of a mild recession, not anything associated close to what we saw in 2020 or 2008, what we would think of as an economic crash or a market crash.
No, you keep saying the word recession. At the beginning of the video, I said the not recession,
Yes.
Because a lot of people are saying we're in a recession, but now you're saying if we see a recession. So can you clarify kind of what's going on there?
So we're in a very unique period, and that's why there's some debate about whether we're in a recession or will be soon. So we want to start by thinking about the official definition of recession. That's decided by the NBER, the National Bureau of Economic Research, and they use a variety of factors, including GDP growth, including employment levels overall, income levels, retail sales, inventory levels. There are a variety of metrics that they use to define what a recession is and when we're in a recession. And they only make that decision well after the fact, because they are looking historically and trying to put the long run context or put the current economic conditions into long run historical context. So we won't know if we're officially into a recession until well after the fact. But having said that, there is a more colloquial or rule of thumb definition that most of us have in mind when we think about a recession, and that is 2 consecutive quarters of negative GDP growth. And that we have definitely seen in 2022 in the first and second quarters, negative GDP growth. And so again, that usually indicates that we're likely in a recession. But again, in 2022, we're in a very unique period because 2 negative quarters of economic growth usually brings with it negative economic activity across the board, especially in the labor market. And that's not what we're seeing this year either. So we still have historically low unemployment across the US, and especially here in South Carolina. Our current unemployment rate is 3.2%. So the labor market continues to be strong, and that is very much at odds with 2 negative quarters of economic growth. And it gives us some pause as to whether we're really in a recession or whether we are likely going to see a bounce back later this year. I think if we do see a significant pullback in employment levels, that would indicate that we're more likely to be headed towards a recession.
So if we do head towards that recession, what does that have to do with the housing market here? There's so many, everyone's screaming crash, the sky is falling, which, as you and I both know, and people have seen on my videos, I am not in team crash. I don't think it's going to happen. But what does this all have to do in relation to that? Like, could that spark a crash, or do you think we're going to keep continuing at the levels, or just like a slower level of growth in the housing market?
Well, we're already definitely seeing a pullback in terms of housing sales. So that's certainly true in Charleston. It's true across South Carolina and across the U.S. And the reason for that is primarily due to affordability, where we're seeing mortgage interest rates rise this year, and we're seeing a steady increase in house prices going along with that. And in addition, we're seeing consumer spending patterns change a bit. So in 2020 and 2021, everybody was staying at home. They weren't going out and traveling, and they weren't going out to restaurants, and they weren't spending on services. They were spending their money on goods instead. If you think about the economy and consumers as in terms of their spending patterns as being divided between spending on goods and services. So the pendulum really swung towards the goods market, and that included housing, which stimulated demand. And now this year, people are beginning to go out more, and they are spending more on services. So this pendulum is swinging back towards the services market. So when you combine that movement in spending patterns with the lower affordability that we were seeing this year, that's why we're seeing a pullback in sales activity closer to what we were seeing before the pandemic began. So that's where we are right now. And as we move into the second half of the year, the real question is, how much will mortgage interest rates continue to rise as the Federal Reserve continues to raise interest rates to combat inflation, which we can talk about. And then also we can think about other metrics with respect to the labor market, keeping in mind that the biggest single predictor for housing demand is employment growth, the strength of the labor market overall. So as long as unemployment remains low, that's a good sign that the pullback that we've seen so far this year, any additional pullback would be minimal, as opposed if we see the unemployment rate go up, which suggests that there may be some additional room for contraction before this pullback stabilizes.
All right, so it's interesting that you mentioned the jobs, because I want to bring up recently I've had a lot of viewers commenting, and I asked for questions for you specifically from viewers on my channel, and one viewer, Charles Wagensell, I don't know if I'm pronouncing that right. Let me know down in the comments if you're watching, Charles. But he said this. He said, no crash in South Carolina. Between the increase in newly created jobs, inflow of retirees from the North and Midwest, and millennials and Gen Zs entering prime home buying years, South Carolina will fare better than most states. So, I mean, he seems to be right on track with that, with what you're saying, especially with that jobs. And, we're seeing, I believe the study was one new home for every 2.25 jobs created in South Carolina. So we're keeping up with that, which is good for us.
Yeah, and I think that's exactly correct. And I think we have to break it down into the short run and the long run economic outlook for housing. And in the short run, I think it's likely that we do see some additional pullback this year, especially if the Federal Reserve continues to raise interest rates, because that's going to slow demand overall and possibly push up unemployment, at least on the margin, which could have an impact on housing markets, of course, as we just talked about. But yes, we also have to think about the structural factors looking long term. And by structural factors, I mean long run changes in the economic climate of South Carolina and in Charleston. And in those factors, we are in great shape. So you mentioned long run outlooks for employment growth and population gains. This region of the country, the Southeast, is poised to see the highest population gains of any region in the U.S. over the next 20 years. And South Carolina and Charleston, right in the heart of the southeastern United States, of course. So we are going to see more people moving in. We're going to see more young people moving in, particularly in Charleston. That's already happening. So I'm very bullish on the long run outlook for housing in Charleston and in South Carolina. But that doesn't mean we are not going to see any further disruptions this year in 2022.
Yeah, and I want to bring up another comment by Don't Touch My Silver, said that he was team crash for any home valued over $1 million, and homes up to $999,000 won't drop as much. So I prodded him a little bit. I wanted to see where he was coming from. And here's what he said. There will always be a larger pool of buyers entering the housing market in that price range, so the demand will always stay high. especially with first-time millennial buyers and retirees downsizing. So it's easier to qualify for that home. But he doesn't see that kind of dip in a million over. So I think that's an interesting take to kind of split the market, that half of it might considered a crash while the other half continues to thrive more. What would you say? Could that happen? Like, could we have a split market?
It really all comes down. Yes, I think you're going to see different market segments, different price points react differently in this environment. We're already seeing where the decline in housing affordability is affecting the first-time home buyers as prices continue to rise and mortgage interest rates go up. So there's been more of a pullback in the lower price points than there has in the upper price points so far. But that's not necessarily going to be the case indefinitely. And especially in Charleston, where we do see a lot of people moving in, particularly from the New England area, which is where a disproportionate amount of people coming from out of state where they originate. In that case, in many cases, they're able to basically sell these larger or their homes that have are for very high price points, and then come down and cash in and be able to buy in South Carolina a lot more house for the dollars that they were able to get up in the New England area, just because the cost of living is so different and the cost of housing. So that puts the upper price points in a better position. So it really depends on the demographics and the price points that you're talking about. But yes, the market can have very different effects.
Yeah, I mean, I've been seeing that a lot. I think what's really going to play into this is the whole work from home. Is that going to continue to be a trend? Because we've seen, like you said, so many people from New York, New Jersey, Connecticut, these higher priced, higher taxed states moving down here, but still keeping their salary as if they lived in New York City.
Yes.
So down here, as a state, Charleston is extremely expensive when you look at South Carolina as a whole. But when you look at it across the country, we're just slightly above average cost of living. So for us, it's super expensive. But for everyone else, we're this pocket next to the beach where it doesn't snow, where their dollar stretches a lot further. And that's why I think if that's going to play a big part, this work from home is going to play a big part in our market and what happens with people. Are they going to continue to shift around the country, and are they going to keep that pay?
Yeah, I think that's exactly right. We don't know exactly how it's going to play out. I think it's too early to tell whether the work from home environment is going to be long term. I think it certainly will be incorporated more into the professional norms. How much so is I think still just to be determined. We just don't know how it's going to all play out yet. But there's no question that that's going to be more important for South Carolina and for Charleston, even as an economic development strategy, right? Providing ways and ways to bring more people here and to keep people in Charleston and in South Carolina by saying you can live here and work anywhere. And when you make that pitch to individuals, then they are more likely to stay in South Carolina and in Charleston, because this is a lower cost of living state. We have a lot of natural amenities. There are a lot of reasons people want to be here, especially if they can be connected with a job anywhere in the world. That makes South Carolina far more attractive. So it definitely works to our advantage.
Now, sticking with that, we, as the state as a whole, we saw last year, like the top 10 companies that invested in South Carolina was almost like $2.5 trillion. With Google and Walmart and Volvo and BMW and all this. Do you see more companies moving here because of the cost of living, and then their employees could follow them if they weren't work from home? Or do you think they're just going to kind of stay where they are? Like, do you predict more revenue and more bigger companies either calling South Carolina home or putting a big hub here?
Yes, I think the competitive advantages that South Carolina had before the pandemic are just as strong today and will be in the coming decade. Two of those advantages are infrastructure and workforce training that companies are constantly publicly stating as reasons that they're in South Carolina. Infrastructure, meaning everything from the port of Charleston to our roads and bridges and highway system to our geographic proximity to both the port and to the rest of the U.S. So think about all the export-oriented manufacturers that locate in South Carolina. They have easy access to the global market through the port, as well as to the entire eastern seaboard to distribute and sell goods domestically to Americans. Because keep in mind, most of the U.S. population is actually located east of the Mississippi on the eastern side of the United States. So South Carolina is in a very strong position there. We're going to become more competitive. I think if we look at manufacturing, that's going to continue to be the case. Manufacturing has been the industry that's really driven South Carolina's economy over the previous decade. And then a second industry is the logistics sector, because getting back to these population trends that we are experiencing, if more and more people are moving to the Southeast, then what does that say to distributors like Walmart and Amazon and others? It says that they're going to want to be located in the Southeast to be able to easily distribute goods to those individuals. And once again, that puts South Carolina in a very strong position to house these jobs that are associated with warehousing and distribution and all the transportation and logistics infrastructure that goes with that. So I think manufacturing and the logistics sector are two industries that are really going to drive our growth for the next decade, and that's predicated on these population trends that are, again, on the side of the Southeast and for South Carolina going forward.
Yeah, I mean, you mentioned Walmart. They just put the distribution facility just north of Summerville, north of Charleston, and they probably wanted like 1,000 jobs there. But I found out shortly after they announced it that it wasn't just a distribution facility. It is the distribution facility that sends stuff to the other distribution facilities in the Southeast. So it is, they come off the port, they go there, then they go to the distribution facilities, and then they go to the stores. So that is a huge investment that they made here in Charleston. And we're seeing a lot of that because of the port. But across the rest of the state, like, where do you see or predict that other companies would want to move? Because that's going to bring the jobs, that's going to bring more people, and then that's actually going to help that housing in these other cities. So outside of Charleston, like, where are you seeing those hotspots?
Well, Greenville and Spartanburg certainly has been, both regions have been a manufacturing hotspot over the last decade. I think that's likely to continue to be the case. We know that there's a major pivot in the automotive sector towards electric vehicles. There's going to be a lot of changes going forward with respect to assembly and the supply chain. A lot of that will be anchored in Greenville and Spartanburg, again, because that's the central hub for automotive manufacturing in the state. And also, if we look at Columbia, at the Midlands region, we expect to see more growth as well. But Columbia tends to be more of what I would call the anchor region of the state, meaning that there's not much change in growth patterns, whether we're in a rapid expansion or a recession. Columbia maintains a steady state. Because Columbia has three primary drivers of its economy: the military with Fort Jackson, education, so with the University of South Carolina, and then state government. So all three of those are pretty stable over time. So normally when you see these big economic booms, Charleston and Greenville and Spartanburg are the ones that really see the increase in growth. Columbia tends to be more stable over time.
Right, and those are pretty much our three big cities that we have here. It is. The military.
Well, we can look at Myrtle Beach. That would be the other one.
True.
If you want to look at the other major market, which of course is tourism centric, and a lot of construction going on in Myrtle Beach as well. But it ebbs and flows with market fluctuations. Again, in contrast to what we see in Columbia.
Yep, and then we even see the smaller markets like Aiken, which is essentially Augusta, Georgia. It's right there, but with my friends and agents that sell around the state, like, they're seeing that influx, especially with this work from home. But people that just don't want the hustle bustle, but they can still be close to things. So, I mean, they might not be getting those big corporations, but, would you say like it could be beneficial for smaller businesses that have more of a national global reach to move into these smaller, lower cost of living areas to operate? If they did, like, you don't want to be in New York City, but you could be out in Aiken and still run a worldwide company.
Very much so. I think, especially if you look at professional services, the professional services sector, where that is more compatible with the new norms of doing business virtually and doing business online. Regions with a low cost of living become far more attractive, and especially if they have those natural amenities going for them as well, as South Carolina does. Everything from the mountains to the beaches to a more temperate climate. So yes, I think all regions of South Carolina will benefit, certainly some more than others. And then you also have businesses that are going to be able to tie to some of these larger sectors that have driven the state's economy. So think about manufacturing suppliers. And this could be large suppliers, it could be smaller suppliers. You could think about anything related to the logistics sector. Cybersecurity is another area that is really growing significantly and is going to have to service essentially all industry sectors, and artificial intelligence, that space more generally. So there are a lot of supply chain based businesses that may be relatively small, but are nevertheless servicing these large industry clusters, and they can set up shop and locate in South Carolina too.
And it's also beneficial geographically. I've got a client who he's got a warehouse in New York and one in Miami. And so he was thinking of moving to South Carolina because it was easily accessible to both of those huge markets, but it's a fraction of the cost to live here. And he could still run this huge company from here and still be a short drive away should something happen and he couldn't fly.
Right.
And I thought that was an interesting take, and it makes perfect sense that he could essentially move that company here, but still operate out of such big markets without having to pay that premium there. So it's
remarkable.
A lot of different reasons.
Yeah, and it's remarkable how different housing prices specifically are across the country. If you look at the differences, and we alluded to this point before, that Charleston looks expensive within South Carolina, and it is. But you get outside the state, especially markets like DC or New York or Seattle, and you get a very different picture. So just looking, you think about the engineering sector, aerospace engineering, and you think about Seattle and where Boeing has been, and you look at what the costs are there versus the cost in Charleston. And when you correct for the cost of living, which is predominantly influenced by housing, aerospace engineers are earning more living in Charleston than they are in Seattle. And again, that is just doing a very direct comparison once you adjust for the cost of living. So those workers are better off being in South Carolina if they can be. So that's just one example of how you see these differences manifesting themselves and illustrating why more and more people are moving to this region.
And to put that cost of living into perspective, I think it was on Wallet Hub that I saw this. When you look at, so an average cost of living rating on Wallet Hub is 100. That is the average in the country. And South Carolina as a state, the cost of living was 88. And Charleston, I want to say, was like 111 or 112. So when you look at it from that perspective, our market is significantly higher cost of living than the state. But when you look at the state, it's one of the lowest. So, and that's going back to what I had said before, but like when you put those numbers together, you can really see where that is. Of course, there's different sectors in the Charleston market that are much more. Mount Pleasant's going to be higher, Daniel Island's going to be higher, Sullivan's Island's going to be much higher. But as a whole, the Charleston area is only 11, 12 points above average, and that's another draw. And I think that's another thing that's going to help our housing costs continue, because it's attracting more people. It's attractive to more outside people, which I'm going to get a lot of hate about attracting people to South Carolina, because I always do in my comments. But people are moving here and there's really no stopping it.
Well, and I think that's important for realtors to keep in mind too when they're looking at when they're talking to potential home buyers, to customers, that even though we are looking at a pullback in demand right now, we really have to keep that in perspective, because we are going back to pre-pandemic levels, which was still a very strong housing market. If you think back to 2018 and 2019, those were some pretty good years as well. And the fact that people are moving in will keep demand high. So customers who are concerned about a crash or concerned about a significant retraction and may not want to buy right now need to keep in mind that housing is still a good investment, because when we look over the long run, over 5 to 10 years, for in South Carolina and in Charleston, demand is going to continue to go up. So that's just an important factor to keep in mind when realtors are talking to customers, particularly when they're worried about buying and making a bad decision. Keeping that in perspective is important.
Yeah, no, I know I can't speak for other areas of the state, but here in Charleston, statistically, we haven't been in a balanced market, which is the over 6 months, 7 months of inventory, since like 2013 or 14. So we've always been in a seller's market. And I'm glad you mentioned 2018 and 2019, because I think a lot of people have the memory of a goldfish after what happened over the past 2 years. Because yes, interest rates have skyrocketed and from where they were, but they've skyrocketed back to normal.
Right.
They've skyrocketed back to a sustainable number. So it just, we forget that we're still better off than 2019 in a lot of aspects for home price appreciation and values to go up, because we still have limited inventory. But back then homes were taking 6 months to sell, and people were reducing prices left and right, and no one screamed market crash. And they had a 5.5 interest rate. Now homes take 3 to 4 weeks to sell. One person drops their price and one person pays 5.5% on their interest rate. And now I'm talking to you about if the market's going to crash. And, I think, I'm glad you mentioned that, because it's 3 years ago. That's what we're getting back to, which, like you said, was a strong market and a more sustainable market, which is where we need to get.
Yes, and you hit on that word. I love that word, sustainable, because the last year and a half has not been sustainable in any sense of the word. And you can see that very clearly when you look at the sources of demand. So why? Because I think if you look at the data, it's very clear that housing has been in a bubble. And I know that term can be used to mean different things.
Be careful when you say bubble.
Right.
So because that's another buzzword that people are talking about.
And I want to be clear to viewers, I'm not talking about the bubble from 2008, but a bubble in the sense that we saw a rapid rise in total housing sales. And now we're seeing it pull back to 2019 or 2018 levels. And so why is that the case? What happened there? Well, essentially, there are a couple of things, but the main driver of that demand was the fact that after the recession in 2020, the labor market recovered very quickly. So people went back to work. We got back to full employment in South Carolina in a relatively short period of time. So people were earning wages and able to buy homes again. And secondly, we had the significant federal fiscal stimulus. $6 trillion between 2020 and 2021. That included the stimulus checks that we remember, a variety of tax credits, enhanced unemployment insurance benefits. And even today, because of the combination of the rapid recovery of the labor market and that fiscal stimulus, consumers are still in really good financial shape. The average American household still has a checking account balance that's about 40% higher than it was in 2019. So what does that mean? That means that consumers are able to spend more, and so they were spending more on housing. But again, because a lot of that was due to the federal stimulus, it was by definition temporary. And I like to use the term a caffeine high. We've been on a caffeine high over the last year and a half or so, particularly the housing market. And so we're not crashing; we're just coming down off of that high because of those temporary factors that were elevating demand to an unsustainable level. And we're getting back to the fundamentals now. And I think, again, the levels that we saw in 2018, 2019 are more sustainable. So if we can get there and continue to grow, that's a very healthy market, and one that I think we would be in good shape if we were able to return to those levels.
Yeah, now I want to ask one final question for you that a lot of people are talking about, and I've been asked a lot, and that is, do you feel that the housing prices in South Carolina are overinflated because of all of this, or is it going to just kind of become what it is?
So I think that housing prices are not going to continue to increase at the same rate that they have over the last 2 years. I think they will settle down because demand is coming back down for the reasons we just talked about. But the other big factor we haven't really discussed yet is the undersupply, the historic undersupply that we are seeing in South Carolina and across the U.S. And we know you alluded to before that in Charleston, we have about a 1 month supply now, down from about a 6 month supply, which is a more normal market. But we are not going back to that inventory norm anytime soon. And that's because we've had a decade-long period where we've been underbuilding, going back to the Great Recession in 2008, where a variety of new industry regulations coupled with builder bankruptcies in the fallout of the recession in 2008 led to more risk aversion on the part of builders and just led to systematic underbuilding for the last decade. And so we're seeing the results of that now, where even though we've seen a pullback in demand, because supply is so low, prices are continuing to rise. So all that to say that prices will begin to level off because demand is retracting, but that lack of supply is going to keep them from coming down to levels that we might have otherwise expected them to be.
So I have a question for you here. Maybe we can debate this. So you say, and I hear a lot of people saying that housing supply is low. The supply is low, which in relation to the demand, yes, housing supply is extremely low. But when we look at the past 2 years here in Charleston, they were record-setting sales. And if supply was so low, how did we set records in closed sales? What's your take on that? I think you have to look at it a different way. When you say supply is low, it's how many are active on the market now.
Right.
But we actually had more supply. It just sold much faster than it ever had.
Yes. Well, I think a lot of that goes back to pricing, and you see prices adjust to reflect the lower supply. So you can still have greater sales when people are moving in and when people are moving around, either within the region or they're coming in from outside the region. But when you have more sales happening in the face of low supply, you're going to see higher prices. So I think all of that is compatible. Each of these factors we're talking about is compatible, but price is the factor there that adjusts when you have high demand and very low supply. And that's exactly what we're seeing.
I've had a lot of debates and conversations about that. Like, was supply actually low? And I know we haven't been building, but again, we've been selling more than ever. And it has created this perceived, we only have 100 homes for sale, but we just sold 3,000 in 2 days.
Right.
So really we had 3,100 homes for sale. So it's just an interesting, the way that people perceive what had happened. I think that demand created a low supply, even though that supply was still going up.
Right.
Yes. It just, that off balance happened that, instead of being even, that demand rose and supply just kind of trickled a little bit. And then we got into where we were, and we all know what happened.
Yeah, exactly. And you raise a very good point about what does it mean to be low on supply. So normally when we hear undersupply, what we mean is not a sufficient supply to keep prices from rising to the degree that we want, or it enables prices to rise faster than what consumers or homebuyers would otherwise like to see, creating problems with affordability and other challenges. But if we say, well, if prices adjust, strictly speaking, then you're right. We don't have a supply issue, because for any given level of supply, if prices are allowed to adjust, then they ensure that again, buyers and sellers are able to make a transaction. But if we want prices to be lower overall or to not appreciate as much, that's where the undersupply, or that's where the term undersupply really comes from. It implies that we want prices not to be rising as quickly as they are, because that impacts affordability.
All right. Well, thanks for clarifying. So now everybody understands what we're talking about when we say we don't have any homes for sale. So
yes. Well, if we're trying, especially if we're trying to, or if we don't like the prices are increasing as quickly as they are, then yes, in that case we have a supply problem. If prices rising is, if that's more the norm, then you could argue that maybe supply isn't quite as much of a problem as it otherwise might be.
All right. Well, if you could leave all the viewers with one soundbite, your knowledge in a nutshell of what's going to happen from now until the end of the year. What's your prediction? Like, summarize that for everyone. Let's finish them off with something real good that they can take home.
Well, in the short run for the rest of this year, I think viewers need to be prepared for more volatility and perhaps a bit more of a pullback in the housing market. We're not out of the woods yet with respect to this high inflation, and that's what the Fed is most targeted on, most focused on right now. But in the long run, if we look to 2023 and beyond, we see the demand factors driving the housing market in Charleston all very strong. So we are very bullish on the outlook for Charleston housing over the next several years, even though for the rest of this year, we may continue to see some mild pullback. So that's what I would say viewers need to be mostly thinking about right now.
All right. Well, everyone, Dr. Joey Van Nessen, thank you so much for joining me. And to everyone watching, let us know what you think in the comments. He's the professional, but do you agree with him or do you disagree with him? Like, let's get that conversation started down below. And Joey, you have a wonderful day, and we'll bring you back. Maybe towards the end of the year, we'll have you back. We'll see, and we'll replay some of your sound bites and see exactly how accurate you were.
That sounds good. Well, thank you, Bill. It's my pleasure to be here, and appreciate your having me today.
Oh, not a problem. Everyone, thanks so much for watching. And if you like this video, I've got this video right here that I really think you're going to love. And if you want to see the first video I did with Dr. Joey Van Nessen, I've got that one right up here, and we will see you on one of those videos.